Hey, so sometimes if you're a person who's looking for a representative, don't have one, and you're getting into conversations, maybe phone interviews or whatever, to see if you can secure a representative of your choice. And of course, as you probably know, they're going to do a bit of vetting of your situation to see if it's going to be something that they would decide to handle. And that usually depends on the viability of the case. Um, we have our whole thing about vocational profiles, and some are going to be more difficult and or when combined with other information, particularly about the impairments, the level of treatment the person has opted to get so far, etc., could make um, the vocational profile be the ending deciding factor after figuring out if the person has, done their due diligence in getting their treatment on top of what the impairments are to begin with. So you might find that the person asks you a lot of questions that you don't really want to deal with. You just want them to take your case and run with it. I'm disabled. None of that should matter. The truth of the matter is it does matter. And I will say, I did something I don't normally do. I was kind of hashing out some questions with somebody via email. Because I got the sense there was some reasons why it was going to be certain questions had to be answered before I was even going to go to, yeah, you got an hour of my time on the phone. Now, don't get me wrong, the emails probably took more than an hour, but at least I have everything documented because phone calls are not documented. So I needed to be able to get a piece of information that would affect a different piece of information, blah, blah, blah. Anyway, the bottom line is if you, and that's what this particular one is about. If you are, other retirement or below retirement age and you're seeking disability, you know how we talk about the recency rule. You have to have 5, quote unquote, 5 working years in the last 10. Really what it is 20 earnings credits in the last 40 quarters. So it doesn't have to be the last 5 years if you're claiming disability now, but it's got to be within the 10 years prior to the date you're claiming disability, and it could be spread out. So it's very part-time work, and that part-time work can also be sporadic, right? It's going to have to hit at least 5 calendar years, however, because you can only get 4 in a year. So sometimes to be able to do 2, 2, 2, 2, 2 for 10 years, or 3, 1, 3. So there's many ways to skin that cat with a history of working, even very part-time. But what do you do if you find yourself, you don't even have 40 credits in your lifetime? Because that is another requirement. It's not for the very young, but once we hit a certain age of adulthood, it is expected that you have put in 10 years of work. It could be 60 and you still have had to have put in, and when I say 10 years, it's that 40 credits. So it could actually be 20 years of a lesser amount, right? So you have your total, that gets you kind of vested in retirement, that having those 40 quarters over your lifetime, no matter when they were, they don't go away for retirement purposes. If you want to file for disability, on the other hand, you would have to have a certain amount, at least in the last 40 quarters, which is 10 years prior to the date you allege you're disabled. So, comes up with a situation where the person realizes that, 15 years ago, he or she, was working, self-employed, maybe a gig, maybe something from home, whatever, was not a W-2 person. And at the time, and I say this all the time, guys, don't always write off everything you can to get 0 taxes. But that's what the person apparently did. And now 15 years later, when they're a few credits short of being able to even file for retirement, want to pay the taxes and give me my credits. Not so fast, buckaroo. We have that 3-3-15 rule. I have another video on that. I'm going to share it here. But you have 3 years, 3 months, and 15 days after the due date, the due year, I should say, of a tax. And 15 years is far beyond 3, 3, and 15, right? 3 years, 3 months, 15 days. So you can go ahead and pay those taxes, but it's not going to do you any help in getting you the credits. So in that case, the only thing you can do really is find a job you can do, even if you are now disabled, whether you are very aged and you, because, you could be 75 pardon me, guys, I got these allergies, 75, and go get a couple credits, and then boost you up, and you can finally collect what probably meager Social Security you could otherwise get. Let's say you need 5 credits. You could technically get that in less than 1 month. Now, the way you would do that is you want to get, I mean, you could just, if you're in 2024, go ahead and earn your 1730 times 4 between now and end of the year. If you find yourself it's December and you didn't know this, December of 2024, make a huge amount of money in December 2024. That might not be very easy, right? But technically that's something you could do. If you could earn that 4 times 1730, whatever that amount is, in 2024, and that's the amount you pay the taxes on. You don't write it all off because you can write off the home office, a cell phone, and everything else, or cost of goods, you know, if you're selling knickknacks. And then you can get you can earn the next quarter in the next calendar year, January of 2025. And then you will have all the work credits you need. Now, it takes time for SSA to register these and get these all accounted for, but technically you could do that. If you could make that, whatever that 7,000 in December, 1730 in January, even in the first week in January, you know, if you got it, if you got the ability and the opportunity, in theory, you can do it within last 2 weeks in December and the first 2 weeks in January, and you've now got 5 credits. Technically, you could get 8 doing that. So can't do more than 8 though. Not that way. Anywho, 3-3-15 rule, guys. If you cash is king, no, it's not. And if you thought you were pulling a smart one years ago by not, trying to write off everything to not pay any taxes, this is where it bites you in the butt. IRS will always take your money. SSA will not always give you the credits. So keep it in mind. All right. I'll attach the other video on 3-3-15 so you get another grasp on that. Have a great day. Bye. Hey, so if the subject matter of the video you just listened to is of interest and you want more on it, stay tuned. Here's another one about the same topic, but a little bit different. Bye now. Hey, welcome to All Things Social Security. As you can see, we had a big snowstorm here up in the Poconos. Yeah, at least I'd say a foot of snow. So I did my little, had my 3rd lesson in snow blowing. But what I wanted to talk to you about was something that arose today with a person seeking representation. And I did connect with the person to get some details because I saw some concerns that regardless of whether I would be taking it, he should know about. So this has to do with, we speak about DLI, date last insured, and you can find videos on that under my channel. But a lot of times a person, and I don't know how people remain uninformed on this as we get into our adulthood. But when we are self-employed, and this is true whether we have a 1099 as a self-employed, say, gigger, or when your customers happen to be big companies and they issue a 1099 when they pay you, you are self-employed, but you get a 1099. All of my colleagues and I, we all get 1099s from the SSA. Ironically, the SSA isn't the one that's actually paying us. It's not the SSA's money or the U.S. Treasury's money. It is the client's money, but the SSA, as you know, withholds a piece of their back benefits to pay the lawyer or the non-attorney rep. And then several years ago, they decided to make a 1099 situation out of it. I would have to imagine that they had concerns that representatives were not reporting the income, which is craziness to me. But in any event, 1099s, or if you don't get a 1099 because you have a business and your customers pay you, but they don't give you a 1099, they just pay their bill, pay the invoice, whatever. If you don't file your tax return, you're not going to get any Social Security credits for that earnings that you would have paid the taxes on. Okay. Now, what if you're just a slowpoke and you tend to be late with your tax returns? That's not that unusual. I think that's a stress creator. You know, for self-employed people, I don't know how you sleep when you know you haven't filed your taxes. I would just be terrified. But that's just me. I'm a bit of a worrywart. So if, let's say you're looking back, so where are we at? We're at 23. We have like a month or two more to file our taxes for 23, to file them timely. Of course, then there's always the opportunity for an extension until October. But let's say we didn't file in 2022. Procrastination, whatever, you're not going to get the credits for that. So if you are in the middle of fighting a claim for Social Security disability, or you're planning to, your date last insured, if you're not working or if you're not filing those tax returns as a self-employed person, your date last insured is approaching. And the only way you can stop it is by reporting income earned and paying those taxes on it. So 2022, you could certainly file a belated tax return. You could always file, I think, a belated tax return. However, what's important to know is if you delay too long, even if you file the tax return and pay those taxes, what have you, you're not going to get Social Security earnings credits after a certain period of time, even if you do that. The rule is the 3-3-15 rule. Your return for year X has to be done within 3 years, 3 months, and 15 days at the end of year, from the end of year X, the earnings year. So for instance, this year, if you had 2021 earnings, if I'm doing the math right, you're going to want that filed by, I guess that would be April 15th. 3 months and 15 days after the third year. So if we had 21, 22 was 1 year, 23 was another year, 24 is the third year, 3-3-15, third year, third month, plus 15 days. So January, February, March, plus 15 puts us into April 15, which is kind of like the time we're normally supposed to have our tax returns in for the given year. But you know, you could be giving up a lot if you're in that realm of filing, potentially filing. You have filed, but you don't know if you're going to win. You might have to refile. If you have to refile and you're not insured after a denial for the next period of time that you're going to try for, you're going to be out of luck. Okay. This particular individual, it appeared like there was some procrastination with filing returns. So I just wanted to share with him that there is a deadline. So if there was work in 20, and you know, that while you should still probably always file your return, that's not going to be a return he's going to get Social Security credits for, because they have that deadline. I don't know why they have the deadline. It doesn't necessarily seem fair when you consider other things that don't have such a deadline, like perhaps statutes of limitations by the IRS and whatnot, or even the SSA coming after people for overpayments. They don't seem to have a 3-3-15 rule for that. They do overpayment charges so many years later, it's not even funny. And by then, a person can barely defend themselves because they don't have the paperwork, because they had no idea it was an issue. Yeah, so the 3-3-15 rule. Give it some thought when you're filing, like right now, because you only have, you know, a few more weeks, seriously, right, until April. And if you're in this boat, did you file your return in 21? If you did not, now's the time. If you're going to do it and you want to get Social Security earnings credits, now's the time to do it, because you only have a very short period of time. 2020, obviously, that's scrolled off the board. You're not getting credit for those. This, I do not think would, I haven't researched this, but I believe if you were a W-2, because your employer reported the earnings, and this is something we should look up, but I'm just going to throw it out there. And again, I'm not sure on the answer. If you're a W-2er, those earnings show up in the detailed earnings report that the SSA puts out, and the Office of Hearings Operations downloads it before a hearing to have more evidence of what work was done for other purposes, you know, relevant to the hearing. So they will know about that earnings. And you'd tend to think they would know about 1099 earnings too, and they would show up. But I just know if you don't have a tax return, they're telling us, with that self-employed earnings, that is what's going to be the bar for you getting the credit. So that may not apply to W-2 lack of tax return, but don't hold me to it. You should definitely file just to protect yourself if for no other reason. Who knows, maybe you'll be getting a refund. But anyway, so 2021 is right now the year that's about to scroll off your board if you haven't filed for that tax year. So I suggest you give it some thought as to whether you should be doing that. Okay. And of course, speak to a tax professional. Yeah, I think going back to the employers with the W-2s, I think the employers do report the income to the SSA. So that will show up and you'll get credit for it regardless perhaps of whether you file a return. Because remember, not everybody always has to file returns. But it's those self-employed people like myself who the SSA has no idea what you're earning. In theory, you'd think again with a 1099 they would, because someone reported it, right? But in any event, you want to stay on top of that. Go to your earnings report in your ssa.gov/my account file access. Get into your file, download your earnings statement, and it's going to show you everything that the SSA says that they have in your file as to your earnings. So you'll know if you're getting credit for 2019, 2020, 2021. You know, the unfortunate thing with the person I spoke to today is that without recent years earnings, such as 19, 20, 21, I think his DLI is 2017. And how do you, it's very, very hard to prove a remote onset. So it's not a case I can take because it's got to have a viable path, a recognizable path to prevailing. And because the DLI is so old and tax returns, perhaps if they should have been filed, were not filed, this person would not be getting credits for that would extend out his date last insured further. Maybe it could have gotten it to 2020 when another serious medical impairment struck him. That might have then been able to be included, but now it can't be because any subsequent medical impairment is after he didn't have the insurance. So you can't claim a disability for a period of time you didn't buy the insurance for. And that's what DLI, date last insured, is all about. So get those earnings credits by filing those tax returns. All right. Bye, guys.